All right. So good morning, everyone. Thrilled that so many of our brokerage managers are on this call today. Joining us are Cheryl. Give us a wave, Cheryl. Oh, pretty in purple. Daniel, Shannon, Delinda, and myself, Sam. Together, we cover the Southeast and regularly engage with producers all across the region. And through these interactions, we've identified some common challenges that producers face, like differentiation, time management. Have you ever had a stalled case out there? I know we all have, and it seems to hold us back from peak performance. Today, our primary focus is helping you with differentiation, helping you stand out in a crowded market with a unique offering from Guardian. Um, while all of our brokerage managers are invaluable assets, I believe, Shannon will be leading our discussion today. Not only is she a product expert and a trusted colleague, but she's also somebody that I consider a friend. Let me share a quick story that illustrates her expertise in this. Several months ago, we were planning our brokerage team's annual strategy meeting. And I was in charge of the agenda, and I called Guardian to seek out the top seller of this product, Safeguard 360 nationally. To no surprise, when I called Guardian for those insights, it turned out that Shannon and her unit was the top sellers of this Safeguard 360. So her depth of knowledge, her strong relationships in the industry speak volumes about her credibility on this topic. So I encourage you all to actively participate in today's session. Feel free to ask questions or make some comments in the chat. We'll be monitoring that. And with that said, Shannon, it's over to you. Take it over.
Thank you, Sam. Good morning, everyone. I hope everyone is having a beautiful day. Um, as Sam said, I am super excited about the Safeguard 360, or what I call the 4-in-1, because it is such a great differentiator for our advisors. For those of you who are unaware, the Safeguard is an industry first. It has never before been done, and it is a Guardian exclusive. I am going to say, for those of you who can, try to stay to the end because I have some exciting, groundbreaking news that my colleagues don't even know about yet. So I will be making that announcement at the end. Um, so I've shared my screen. Can someone give me a thumbs up just to let me know that you can see that and everything looks good? Perfect. So, just FYI, we're going to talk a little bit about just demographically speaking, right? Like, what's the right type of demographic to talk to about Safeguard? And we're going to do a little bit of a deeper dive in terms of the buying behaviors of that demographic. And then I'm definitely going to be talking more about how to position the Safeguard. We're going to be talking about the mechanics of it, the logistics of it, where it really is going to work well, kind of some verbiage in terms of how to uncover opportunities. And then I'm going to show a sample illustration, because one of the most powerful things that my team and I see with Safeguard is really the cost effectiveness of it. More than ever before, consumers, particularly consumers in this marketplace, is looking for value, right? They want to, with all the things that consumers are experiencing nowadays, market volatility, inflation, they really want that dollar doing multiple things for them. And I really think that's the power of Safeguard, is that that dollar can check off so many boxes, right? With ease of implementation as well. So, Safeguard, what's the prime demographic? Well, really, Guardian created this product to appeal to people who are disability insurance buyers, right? And that would be people who are age 50 and younger. These are going to be your primary millennials and Generation Z, like the Gen Zers, right? And this is actually the top two demographics that have the highest level of financial concern. So they really are primed, if both from a characteristic and personality standpoint to be someone that you can coach into purchasing. And they also have exhibited purchasing characteristics that really fit Safeguard very well. Safeguard is, as I mentioned, a 4-in-1. So what is the four? Well, it's long-term disability, right? Or what we in the industry would call income protection or income replacement. When you're sick and hurt, how is your income going to get replaced? How is your bills going to get paid? How are your obligations going to get paid, right? How are you going to keep, I call it a hug plan, housing, utilities, and groceries, because I'm a hugger. That's what I would call your basic survival needs, right? Keeping food in your belly, keeping a roof over your head, and making sure you're not freezing to death or dying of a heat stroke, right? So that's your basic survival needs. How are your clients and consumers that you're coming across, how are they making sure that they have a hug plan in place? How are they able to make sure that those bills get paid? So in terms of financial concern, we see here that demographically speaking, in terms of age, your Generation Z and your millennials are the two highest level in terms of financial concern. The Safeguard has a long-term disability component for income protection. It also has a long-term care component, as well as a legacy component with death benefit to provide for beneficiaries. And then what's also great about it is it generates great cash value. Because this particular plan is built upon a mutual company participating whole life policies. Industry analysis has shown us that if you're purchasing whole life with a mutual company that is a participating policy, over the life of the policy, you are going to generate better than municipal bond returns with no risk. That's the beauty of, I would say, the growth with cash value in a mutual company in a Guardian whole life policy is the fact that this is a guaranteed growth asset. I mean, if you think about what financial assets are out there, how many clients can say that their assets are a guaranteed growth asset with no risk? In today's market volatility, that's extremely powerful proposition. We're seeing that, especially right now with how volatile the markets are, and with the continued projected market volatility, clients and consumers are looking to incorporate and have had much stronger interest in incorporating things like whole life insurance, right? And if you're doing it again with a mutual participating policy like a Guardian policy, you're going to generate better than muni bond returns over the life of the policy. And keep in mind that municipal bonds actually have risks. So in a Guardian whole life scenario, you're going to generate better returns with no risk. That's the power of the proposition, right? So it's those four components. But also the cash value component. You know, when people are buying the Safeguard, they're not necessarily buying it to make money because obviously, you know, you can make higher returns in other places. They're buying it as a protection first strategy. However, if you can provide the proposition of protection first, but be able to recoup and have no lost opportunity costs, that's the additional power of the Safeguard, right? How many protection strategies are you implementing that you can say, hey, not only are you not going to have any lost opportunity costs and you're going to have guaranteed growth, but we're going to recoup all the invested premium and you're going to make money on this policy. I mean, if you tell that to an average consumer, that is extremely powerful. That's going to overcome a lot of your buying objections. So, you know, here's our few of the stats. And by the way, for those of you who are interested, the deck that I'm showing is available to you. So feel free to reach out to your brokerage manager or whoever invited you to this webinar, and we will be able to send this deck to you. But 1 in 4 20-year-olds will become disabled during their working years. And remember, disabled just means illness or injury, right? And so on the Safeguard, the disability component is a true LTD policy. It does not affect cash value, it does not affect death benefit, and it does not affect long-term care benefit. That's the power of the disability policy. I call it a life long-term care policy that builds cash value, and then you basically have stuck a disability policy on top of that, right? And so the benefit period on that is a 5-year benefit period, but it's 5 years per occurrence. And if we know that statistically, an average illness and injury that results in a loss of income or some sort of income impact is going to be recoverable within 3 to 5 years. So a 5 year benefit period per occurrence is actually extremely powerful, especially when you're dealing with a client that wasn't planning to buy because they had some other objection, like, hey, it's a use or lose. I don't get any of the premium back. What if I never use it, right? Um, and then how cost effective it is as well. Half of millennials and Generation Z adults say they will need life insurance or more of it. And almost 70% of people turning 65 today will need some type of LTC service or support in their remaining years. For those of us who work in insurance, I know that all of us at some point have heard, this isn't going to happen to me because I'm super healthy. I'm really, really healthy. Well, the thing about long-term care, and I always say this to every client and advisor, is actually the healthier you are, the more likely you're going to need long-term care. Because how many 100-year-old people do you know that don't have someone checking in on them, running their errands, helping them, take them to the doctor, getting their medications, doing light housekeeping? So actually, if you have longevity in your family or if you're super healthy, then you're actually more likely to need long-term care, because if you're not healthy, you're probably just going to pass away, right? Earlier. Which Safeguard also has that component as well, right? So it just really checks off multiple boxes. So let's understand a little bit more about the buying demographic, which is the under 50, Gen Z, and millennials. Here are some kind of characteristics about them, but the interesting things that I find about the Gen Z is that 55% of them overestimate the cost of life insurance by over 5 times the actual cost. 49% say they need more life insurance. 29% say they don't know what type of life insurance to buy, so it stops them from making a buying decision. And almost half of this group say that they intend to buy some life insurance this year. If you look at the millennials with those same points, 47% say they need to increase life insurance. 50% are planning to buy this year. 46% have overestimated the cost of life insurance by more than 5 times. And 31% say that they have paralysis because they don't know what type of life insurance to buy. So what all of that just tells me is that we as advisors need to be talking to this group and educating them. What that tells me is that this group needs an advisor. This group needs people to provide correct and accurate information and guidance. So if those of you who are not working with this market, or you may not know how to work with this market, right? As my colleague Sam mentioned, our team specializes in working with our advisors in a very different way than other wholesalers. We really kind of help our advisors hone in on their pain points. Consultants and market research has shown us that financial advisors, whether they're insurance advisors, property and casualty advisors, just financial services advisors across the board, really have 6 similar pain points. One, as Sam mentioned, is differentiation, and Safeguard definitely can help you with that. Two is productivity, right? You find that there might be cases that are stuck in underwriting. You're having to run after medical records, tons of other things. Whatever you're doing, maybe you sell primarily health insurance, and so you're not able to adequately be able to pivot. That goes into another pain point, which is the capacity issue. Also, we deal with client procrastination, right? Clients don't do lab work, or they schedule lab work 3 months out. Clients are not signing their applications, whatever it may be. And then one of the number one things we hear is lead generation, marketing, and prospecting. How do I get more clients? And then also, ultimately, am I building a healthy practice? Am I building a practice that's sustainable throughout my career, right? And so our brokerage team differentiates ourselves because we're able to actually help advisors provide solutions in all those areas. So Safeguard definitely hit those points as well. And I'll talk a little bit more about how we can do that. So that was the life insurance component of Safeguard. But what are some of the facts when it comes to the disability and the long-term care component? Well, more than a quarter of consumers say that they're entering the workforce is the top reason that they purchase disability, right? That would make sense. They're working, they're producing income, so they're concerned about how to protect that income if they can't produce the income that they need. 6 in 10 Gen Z and millennials say they're worried about the financial impact of becoming disabled. 23% of people who require long-term care require it because of long-term habilitation from an accident, and 31% who require long-term care require it because of an illness. We have seen that there is an increasingly strong interest in combination products. 39% of millennials say that they are very likely to purchase a life insurance combination product, while 28% say the same. The one point I will say in terms of why we don't see that statistic be higher, and I do believe it will become increasingly higher, is the fact that this is an industry first product. People aren't even aware that this financial tool even exists. And so I can tell you that the reason our team sells so much of it, we have no magic formula. The reason that we sell so much of it is because we educate consumers that this tool is available. Literally every consumer and client that we show this product to ends up buying. Because why? It doesn't matter what their hot button is. It doesn't matter if their concern is income replacement because of an illness or injury for disability. Doesn't matter if they're concerned about legacy planning and want to leave money to their heirs for life insurance. It doesn't matter if they're concerned about long-term care and what happens if I need care in my older age. It doesn't matter if they're looking for some sort of buffer asset to absorb volatility from the other investments because the market is so volatile, right? It doesn't matter if they're concerned about not having a use or lose scenario. This product is going to be able to check off all of those boxes. So there's really no reason for someone to have any kind of cost objection, especially when I send you or when I show you our sample illustration on what this product looks like from a cost standpoint, and you just see how cost effective it is. It really kind of eliminates the cost objection as well, right? Especially now knowing that you're going to end up making more than what you invested in premium in this product, and you're able to check off all those protection components. I mean, that's a win-win. The beauty of the Safeguard is it's not life insurance, or it's not just life insurance. It's also living benefits. So one of the objections that you might hear when you're selling life insurance is, well, unfortunately, sometimes we talk to clients and they say, well, I'm dead. I don't really care what happens to people. Well, or my family or the people I leave behind. Not the best response, however, we know that that occurs. The beauty of the Safeguard is if you run across someone like that and they don't care, well, the thing is that person that doesn't care what happens to the people that they leave behind, they're going to be the first one that's concerned about how their own lifestyle is affected if they end up getting sick and hurt and they're disabled, right? And they're not able to produce income. They're going to be the first one to be concerned about who's going to take care of me if I need care, right? So there's these living benefits components. Now, those of you who sell permanent life insurance know that the cash value is extremely powerful, especially in a guaranteed growth, no risk product like whole life insurance, because though that cash value there can be great to help supplement retirement because it is a tax-free growth, tax-free distribution product. It's great for even right now. There are situations right now where we have retirees that may be needing, they're living on a retirement income, but a lot of their retirement income might be coming out of 401ks or might be coming out of stocks or mutual funds. Well, they still need that retirement income, but they don't really want to be selling their assets or their stocks and mutual funds or taking that 401k money right now when the market is down. But where are they going to need that income from? Well, for our clients who have guaranteed whole life insurance, they're going to be able to take money out of their cash value to supplement that retirement and let that money in the 401k or in the market volatile products like the stocks and mutual funds ride out until the market rebounds so they don't have to sell at a loss, right? So again, that cash value can help with so many different purposes and enhance so many other financial strategies. Long-term care expenses. We talked about long-term care is fast becoming the single largest reason why retirees' incomes and assets become cannibalized because of not properly planned for long-term care life events. I always say to clients and advisors, listen, our job, we can't predict when life events will occur. Our job is to plan for life events when and if they occur. And if they don't, our job is to plan for worst case scenario, not best. Because if you plan for worst case scenario, you're always going to come out ahead because typically everything's going to be better than the worst case scenario, right? So most clients out there, most consumers out there have not adequately planned for long-term care, especially in that baby boomer population. In the next slide that I show you, I'll show you how that impacts this particular group, the millennials and the Gen Zs. And again, we talk about value, right? I talked earlier about value, most cost effective. People are looking for that dollar to provide multiple value. That is what this particular product does. It provides better economic use of current assets. So let's take a look at who is providing care. Well, the reason why this particular product hits the millennials and the Gen Zs, it hits them so hard in terms of their hot buttons is because 54% of caregivers fall within that group. 54% of caregivers are between the ages of 25 to 54, right? 66% of caregivers report that they pay for care with their own savings and retirement funds. And gosh, imagine someone who's having to pull those savings and retirement funds out from a market volatile product right now when the market is down. 40% of caregivers are likely an adult child taking care of an aging parent. This is so important. As a matter of fact, long-term care association stats show us that close to 88% of care is actually provided by some sort of family member. And one thing I want all of you to be aware of, and we'll discuss this a little bit more as we talk about the mechanics of the long-term care solutions, including the Safeguard that Guardian offers, is that Guardian's long-term care solutions are all cash indemnity plans. And I will tell you my own personal experiences with long-term care. My parents thankfully did proper planning, and so they have both reimbursement and cash indemnity plans. I'm in charge of handling their care plan. And I will tell you that I would not wish reimbursement plans upon my worst enemy because it literally is like filing taxes, but 12 times a year. So if you enjoy filing taxes, please feel free to buy a reimbursement plan. But if you're like the rest of us who hate that, that is literally what you're having to do. With the cash plan or what's called an indemnity plan, you're just getting paid straight cash. So you have a lot more control over the type of care. I'll also give you, this is something that a lot of consumers definitely don't know, but even advisors as well. And I personally didn't even know this until I had experienced it myself. But with a reimbursement plan, you're also many times not able to access all of your monies, even if you technically trigger care. And I'll give you a personal experience. So my parents live in an assisted living, but they need round the clock care. So I have to hire a private caregiver for them as well. In all facilities, and this is the way that all long-term care facilities set up their kind of their software systems, right, for billing. You've got a first person charge, and then you've got a second person charge. For a couple that are going to live together, the first person gets charged 100% of the cost, and then the second person is probably getting charged about 20 or 30% of the cost of the first person. So in my mom and dad's situation, my mom was the first person, but my dad, they only charge him about 20% of what the first person charge is. So the reimbursement plan would not pay him his full reimbursement benefit, even though he qualifies for the triggers, right? He's got end stage or severe dementia, so he can actually qualify for the entire benefit, but they won't pay him the entire benefit because the bill only has him being charged 20 or 30% of what the full charge is for the person. Then, under a reimbursement plan, typically most reimbursement plans now require a CNA licensed person or many times through a licensed agency in order to pay for a private caregiver. My parents, and I did use CNAs and private caregivers, but my parents don't speak the language. And frankly, I got better care from a lady that had been working with them. She used to be their housekeeper, and then as they aged, she just started taking on more and more of their care needs. She is not CNA licensed. She has never been through any of the training. She has just worked with them so long that she knows how to take care of them. I don't have to pay her as much as I would have to pay a CNA. I pay her very well, but I don't have to pay her as much. But their reimbursement plans would not pay for her. Why? Because she was not through a licensed agency and was not a CNA. So my dad has this reimbursement plan that he's only able to access a small fraction of the total benefit that he's eligible for versus the reimbursement plan would have just paid out all cash, right? Whatever amount of cash. And like, luckily, they do have a reimbursement or an indemnity policy, a small one that I'm able to access some cash as well. But this just goes to show you there's a lot of the mechanics of this that you definitely have to make sure that your clients understand. Most reimbursement plans, as well as many hybrid plans, don't allow are reimbursement, but also don't allow for immediate family members to provide care. All of Guardian's long-term care solutions, including Safeguard, allows for immediate families to provide care. So if you look at the stat here on your screen, 40% of caregivers are likely to be an adult child. And as we mentioned, 88% are going to be some sort of family member, whether it's a spouse, whether it's a grandchild. We're seeing a lot of grandchildren now providing care, nieces, nephews, cousins, whatever, right? So it could be anybody in your family, but if you don't have a policy that's going to allow them to be able to receive benefits or to trigger benefits, that's going to be an issue, especially. I do want to jump down to these last 2 points. 39% of caregivers are reporting having to sell a house to pay for the care of a loved one. So that means a child might be having to sell off an asset to pay for the care of their parents, right? 1 in 4 caregivers contribute more than 30 hours a week of care to a loved one. I hear a lot of clients sometimes say, oh, my child is going to take care of me. My spouse is going to take care of me. And I always question them by saying, how likely is that? And my question is, does your child or your spouse have a job? And if they do, are they willing to quit that job? And what kind of financial impact is that going to have in terms of your child on their own family? Now, if your plan is to have a child take care of you, wouldn't it be nice if you were able to pay your child for the time that he or she came and provided care? And that's what you can do with the Guardian's long-term care programs. And 48% of caregivers report high levels of stress. All right, so I'm going to now kind of move into the mechanics and the process. And this is actually going to be where we discuss a lot of the pain point areas and how the Safeguard is able to help with that. And by the way, the Safeguard is phenomenal. For those of you who might have worked with Guardian in the past, you've always known us to be a paper pusher company, right? Especially in the world of disability. Well, we are no longer a paper pusher company. With the inception of Safeguard, it's phenomenal because Safeguard covers effectively a lot of occupations that you're going to have a hard time finding affordable standalone disability for. One that comes to mind is chiropractors. You're going to see something that goes out from my team about chiropractors shortly, but chiropractors love to buy this particular product because chiropractors typically have a hard time finding standalone disability. And when they have standalone disability available, is extremely expensive, especially when you compare it to a Safeguard. Typically, when we run a standalone chiropractor quote, we find it's about double, triple, sometimes even quadruple the price of what a Safeguard would be without none of the other benefits. Other groups that love Safeguard are your plumbers, your electricians. We sell a lot to masseuses or cosmetologists, people who are 1099. They're basically with the Safeguard, they're creating their own benefits package, right? So a lot of small business owners love to buy the Safeguard because with one implementation, they're able to essentially set up their own benefits package. And then in terms of the mechanics of it, Safeguard can be implemented with or is implemented with one application And that application covers everything, and there is no lab work and one medical questionnaire. We don't require any lab work, no blood, urine, none of that. There's no nurse visit in order to acquire Safeguard coverage. It is literally an online application and an online medical questionnaire that can be completed by the client at their convenience in order to implement. And with that implementation, again, you're going to get all of the different features available, the disability, long-term care, life insurance, and the cash value component as well. This is also why Safeguard. So when we talk about some positioning opportunities, not only personally, I think all of you can see where this just works phenomenally well in personal planning. Again, with one implementation, you're implementing the foundation of all the planning protections that you need, right? It's a great it's a great starter plan if the client, ends up needing more coverage. But for some people, it may be the only plan that they ever utilize or that they ever need. But let's talk about it in terms of business opportunities. For those of you who are employee benefits or you work with business owners, there's several great business opportunities. For my employee benefits advisors out there, this is a great employee benefit all-in-one plan for those businesses that can't implement group LTD because they're too small, right? The employer may not want to pay any of the premium. They can't implement group life insurance because maybe the employer doesn't want to pay premium, or they can't meet the participation requirements, or the group is too small. Whatever the reason is, Safeguard tends to be a really good option. It's also a great option, as I mentioned, with 1099 employees as well, right? In terms of the business planning arena, we see Safeguard utilized a lot with key person planning. If you think about on key person planning, those of you who are on this call, I'm sure many of you have implemented life insurance key person planning. That's typically what most people implement when they look at key person. They implement life insurance. So, how many of your business owners have implemented more than just life insurance when it comes to key person planning? Have they implemented the disability for illness and injury? As I mentioned, majority of key person planning is done with life insurance. Yet, we know that statistically, you are far more likely to become disabled, sick, and hurt prior to retirement age than you are to die. That's the reason why term insurance only pays out in 2% of the time, because people don't die prior to retirement age. And yet businesses are actually planning for death and not planning for the more likely event of illness and injury. Why do people only plan for life insurance? Because then they would have to come up with additional dollars, additional premium dollars to pay for disability, have to come up with additional premium dollars to pay for any kind of long-term care, right? So it's more dollars that have to be implemented. When you implement Safeguard, you're going to be implementing the disability for key person planning, the life insurance for key person planning. You can still obviously implement additional term insurance because Safeguard is a whole life policy, right? But you can implement Safeguard with a low whole life death benefit and still do term. But with this implementation, the beauty of it also goes into the second piece of it, which is executive benefits. We're finding that attracting, retaining, and recruiting is extremely important, especially in highly skilled occupations. Executive bonus plans are one that is phenomenal to do with Safeguard. And you can actually utilize key person planning and then have it transition into a benefit once the employee gets older. So they can have the key person planning while they're still working with you, and then you can have an agreement with them that you can pay up the policy, which, by the way, you can pay up the policy with Safeguard. But you can also now be able to change ownership and let them take this particular policy into retirement with them. And now they've got long-term care. They've got a great pool of cash value that can be utilized for them to supplement retirement income. It's a great executive benefit as well. So we definitely use this a lot in terms of business planning, not only in terms of employee benefit, but also in terms of executive benefits and also key person planning for the business. And then I'm going to show you now what an illustration looks like. So this is actually a rich client. This was the first client that bought Safeguard with Guardian when it was launched. This particular client was our client who was age 35 and he was a plumber. Made about $100,000 a year. This particular client actually came to the advisor looking for disability. So the advisor ran the disability quote for them. It was a blue collar disability policy, 5,000 a month, and the premium was roughly about $175 a month. At that time, the advisor happened to get an email from me saying that we had just launched the Safeguard. So he calls me, he says, Shannon, am I reading this correct? That this is a all-in-one disability, life, and long-term care? I said, yeah. He goes, well, run this for the client. So we ran the quote for the client for the same 5,000 a month of disability coverage. But now his premium was $177 a month. So over just $2.50 more. Now the client was going to have, number one, at mortality age, he was going to have over $404,000 of death benefit to be able to pass on his legacy to his family. Out of that 404,000, $356,000 is going to be cash that he can access if he needs to. He only invested $105,000 over the life of this policy. So even at age 90, he only invested over $105,000 and he's tripled his money back in cash with no risk, ladies and gentlemen, no risk and guaranteed returns, right? And he has the death benefit. You know, when we show the client the death benefit here, he was like, this, and I'll never forget that he said this. He said, I would never be able to leave that amount of cash to my family if I didn't have this. And he always just thought whole life insurance was unaffordable, right? He had heard about it, but he always thought it was unaffordable. And then we showed him the long-term care. At age 80, which majority of long-term care claims occur at age 80, he would have over $11,200 of tax-free cash long-term care benefit that is accessible even if immediate family members provide care. Again, cash benefit. All for $2.50 more than what he would have paid in standalone disability. And he would have not gotten any of that money back because it would have been a casualty premium. It was going to be a use or lose. And now he's gotten not only all his money back, but he's tripled his invested premium into this policy. So he was able to implement this. And by the way, this is not always the case, but on this particular occupation, which was a plumber, the definition under the safeguard was more robust. There was no Social Security offset, as is normally required under blue collar disability policies. So he had better definition and better disability policy and all these other benefits. Now, I'm going to ask you, do you think he bought? Of course, right? So that is where the cost effectiveness and the power of the safeguard is. All right. So lastly, I'm going to, before I go into a Q&A, I'm going to just announce to you that Guardian will be releasing a customizable platform for Safeguard come May. So right now, Safeguard is only available in a 4-in-1 package deal. Come May, probably early June, we know that Safeguard will now be allowed to be broken up into if you just want a disability with the life insurance, you could have that. If you wanted the long-term care with the life insurance, but on a less expensive platform, you could have that. Guardian has some exclusive products and features that if you're not aware of, please reach out to your brokerage managers. But one of them is an indexing whole life. It is not an IUL. And I say that again, not an IUL. This is exclusive to Guardian. It is a true participating whole life policy that gives you the ability to have upsides up to 11.5% with downsides of guaranteed 5%. So basically, you will not be in a situation where the policy ever loses you money. So it's 5% guaranteed dividend credit with an upside of 11.5%, and you have all of the guarantees on a whole life policy, guaranteed premiums, guaranteed cash values, guaranteed death benefits, guaranteed cost of insurance. And we get that question a lot is, can I get the safeguard with the indexing? In its current format, no. But come May, you will be able to do the indexing whole life if cash or wealth accumulation is your primary purpose with the disability. So definitely look for that and stay tuned for that announcement coming in May. All right. So that's it for.
Based on the activity of attendees joining this, this is definitely a call that has a lot of interest and a lot of folks talking in the marketplace. Thank you for fielding all of those questions. You're getting a lot of thank yous and claps from the chat and the Q&A. So fantastic job. You're definitely one of the best. And with that, we will have more of these coming up next quarter. If you want some follow-up information, if you would like some to talk further, somebody invited you to this meeting. So reach out to that brokerage manager, and we are all here to help provide top-level service to you for you to be as successful as possible in this marketplace. So thank you all for attending. Have a good rest of your week.
Thank you. Have a great day, everybody.
Great job, Shannon.